We are examining three types of accounting exposure: transaction, translation, and operating. Translation exposure, or translation risk, the second category of accounting exposures, arises because the financial statements of foreign subsidiaries, which are stated in foreign currency, must be restated in the parent's reporting currency for the firm to prepare consolidated financial statements. For example, foreign subsidiaries of U.S. companies must restate local euro, pound, yen, and other currencies statements into U.S. dollars so the foreign values can be added to the parent's U.S. dollar denominated balance sheet and income statement. This accounting process is called translation. The two financial statements for each subsidiary which must be translated for consolidation are the income statement and the balance sheet. The statements of cash flow are not translated from the foreign subsidiaries. Most countries specify the translation method to be used by a foreign subsidiary based on its business operations. For example, a foreign subsidiary's business can be categorized as either an integrated foreign entity or a self-sustaining foreign entity. An integrated foreign entity operates as an extension of the parent company with cash flows and business lines that are highly interrelated with those of the parent. A self-sustaining foreign entity operates in the local economic environment independent of the parent company. Functional currency is the currency of the primary economic environment in which the subsidiary operates and in which it generates cash flows. In other words, it's the dominant currency used by the foreign subsidiary in its day-to-day operations. Management must evaluate the nature and purpose of each of its individual foreign subsidiaries to determine the appropriate functional currency for each. There are several translation methods. The current rate method states that all financial statement line items, with a few exceptions, are translated at the current exchange rate. The temporal method states that specific assets and liabilities are translated at exchange rates consistent with the timing of the item's creation. Here in the U.S., our translation procedures differentiate foreign subsidiaries on the basis of functional currency, not subsidiary characterization. In managing translation exposure, the main technique to minimize translation risk is called the balance sheet hedging. This involves speculating in the forward market in the hope that a cash profit will be realized to offset the non-cash loss from translation. This requires an equal amount of exposed foreign currency assets and liabilities on the firm's consolidated balance sheet. If this can be achieved, for each foreign currency, net translation exposure will be zero. A change in the exchange rates will change the value of exposed liabilities in an equal amount, but in a direction opposite to the change in the value of exposed assets. If a firm translates by the temporal method, a zero net exposed position is called monetary balance. This is something that cannot be achieved under the current rate method because total assets would have to be matched by an equal amount of debt, but the equity section of the balance sheet must be translated at historic exchange rates. And that's a brief summary of looking at translation risk and how to manage it.